All right, so Q&A, ask Kish. You bring your questions and I bring the answers. Anyone who's up, just unmute, speak. Normal protocols, guys, be respectful, all that good stuff, you know the drill. What are the real liquidity? Where are the real liquidity? That's a very interesting question. Something about your name looks very familiar. Are you in the 1v1? Queen? Yes. And this is a public Zoom call. But I will try nonetheless to answer as best as I can. In my opinion, I believe that the real liquidity in the market will refer to those areas where more informed traders are going to reference in order to make a decision. So let's say we're looking at the daily chart. And we know that the order flow is bullish, right? Most persons would always, for some reason, always be looking at previous days highs and lows every single time. For me, I don't think that's necessary. I don't think you should look at previous days highs and lows every single day. While I do believe that you should look at previous days highs and lows at some times, I don't think it's an everyday thing. If you have previous days highs and lows confluencing with something else, then I think it makes a lot of sense. So you'll remember this chart I shared. I think the last time I shared a chart, I had this candle's open price mark. Okay, I don't think we'd already gotten there, probably close. So if we know that this is the opening price of a weekly down candle that we close above, so potential order block, and we move to a daily chart, if we see daily lows resting at that level, there, close enough, then if liquidity is resting here, it makes sense for me to watch this liquidity closely and expect a large move to either start here or move away from here. So I'd consider this real liquidity. This is a real liquidity pool, a daily low that is worth watching. So in too many words, I hope that helps. Can you analyze current AU price action? Sure. How do you differentiate between a stop hunt and market structure shift? All right, let's see. Let's go to AU first. First question was AU analysis. Let's clear up all of this. Bam. AU daily chart. What's the daily range? 1. Where are we in that daily range? 2. And where's next drawn liquidity? Those are the non-negotiables. Daily range. Here we are in premium of that daily range.
You done?
And where is the liquidity? Bam, bam, bam. The first thing I saw was this low. I defaulted looking at this low. But if we're bullish and we're trading higher like this, I don't think we need to get all the way down here. This high has already been taken. So in a case like this, I default to external range liquidity, liquidity that's outside of the range. So this candle's high would be my next reference point. For buy side liquidity draw. This candle's high as well, since it's lower than the one on the left, should, in my opinion, also be referenced. And today is Thursday, so no need to look down here. Bam, 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 bam. Hourly chart. Okay, well, looking for automatically muting everyone when they came in. Nonetheless, didn't find it. So this would be the H1 high I'd be looking at for liquidity. We're currently resting just below there. If I was trading today and I was trading,
it's illegal to be gay.
He said when he comes to Dubai, he say his wife is there.
Okay, I'm just gonna mute everyone and get everyone on entrance. And there we go. Much better. So if I was trading AU today for Twain, this would be the imbalance I'll be looking at. I'll be looking at, look forward my entries inside here and then trading higher. Then from here, you know the drill. M5, 8 o'clock minimum. I don't trade before 8 o'clock. And then I'm looking for my setup somewhere inside here. So potentially this would be the first place I'd consider for an entry because of this range right here. You can see that price traded above the range in an underlyingly bullish market. So we're breaking above highs, looking for retracements and then pushing higher. There's no short-term lows inside here. So fib 50% and then we're good. So I believe AU should be trading higher. But I said that some time ago. 0.66, 0.68 should be the next draw on AU based on my model. Forex trader. Yeah, I do have a 1v1 group. That's about it. I don't know if you call it a mentorship. I don't know if the guys inside will call it a mentorship, but it's a 1v1 group where we talk about my model and things that I used to trade, and yeah, nice of the community. There's another question. How do you differentiate between a stop hunt and a market structure shift? That's interesting. So by definition, a stop hunt is a run on stops and then price pulls away. Market structure shift should be a confirmed break in a direction that agrees with the order flow. So not to be cryptic in any way, stop hunts are usually with the against the underlying order flow, and market structure shifts are usually in line with the order flow. So I'd say, again, using EAU, start with the direction of the order flow. In this case, we determined that this was bullish because of where the daily draw on liquidity was, right? So any run on liquidity, in this case, sell side liquidity, while the order flow is still bullish and on its way to the target, I would consider that a stop hunt. Every time we break above highs in a bullish market, that becomes a candidate for a market structure shift higher. So yeah, I guess quick example explanation will be that. Dwayne said it's friendship, not mentorship. How do I join that group? Same instructions I gave since the beginning. PayPal, crypto, and that's it. Mentorship and friendship. Yes, that's it. Questions? I thought that's the questions. Can we look at DXY? Yes, we can. What about it? What about DXY? If I struggle with market direction, what do I do? What would I do? Twain, have you watched the Fire Your Boss video? If you watch the Fire Your Boss video, then all you need is in that video. DXY market direction. Pretty straightforward here. Pretty straightforward. Lower bearish. We looked at this. I think the last time I did a live Telegram call, live Zoom call, we're looking at this low right inside here, and then the imbalance inside here. So as usual, I always like to see when there's a key level or a key point in the market, and then they fail to crush it, retrace, giving persons a reason to put stops here, and then they take it. That comes back to the 4 steps of what I look for when I'm trading. And I think I mentioned that a couple of times before, but just to Hammer it home, accumulation, failure swing, opposing liquidity run, then my entry should form. But yeah, I think this guy's bearish. For right now, I think the condition in the market is a retracement and the order flow is still underlying the bearish. So the retracement should be going lower. And I don't know why I had this marked out, but this looks like where I thought it would get to. So let's see how good my old self is. Good afternoon, D. So bearish DXY for right now. Generally, December going into January, we have risk on, risk off protocols. So DXY strength. So now that we're getting the potential opposing liquidity run, this I'm focused on, can we close below here? Can a down day close below here? That's going to be important. If it fails to do so, based on the price action we have right now, the lowest bodies inside that swing low should act as ICT rejection block, which would make this guy order block candidate. So if this, then that. If we close below here, I move my focus to watching the down candles that close below here. If we don't close below here, this guy should set up the market structure to shift higher. So changing the state of delivery and then bam. Nice and simple. But for right now, as there's less liquidity in the market, intraday trading is where it is. That explains why foreign currencies have been bullish. Yeah. So last week I sent something about what do you expect? Risk on, risk off, da da da. Everybody said risk on. Risk on means DXY weakness. So that alone sets up foreign currencies higher. So you determine if price is retracing versus reversing. So typically I would be very cryptic with this response, but since we have what's it called again? ICD's mentorship on YouTube, I can freely talk about that lesson. So month 1, episode 1, elements to a trade setup. If you haven't watched that video by now, then you should. And if you have watched already, you probably should watch it again. IC talks about the 4 market conditions, as well as the things that you focus on within those conditions. When the market's expanding, you focus on order blocks. Markets retracing, you focus on imbalances. Markets reversing, you focus on liquidity pools. And if we're consolidating, then 50% of the consolidation should be sexy. So how do I determine if it's retracing or reversing? Let's take a look at DXY and use that for example. DXY has been bullish. While it was bullish, there was no clear old high that it was being drawn to right now. So once you got above this, on the immediate left, there's no highs there. There are no highs. So it's expanding higher, right? If this market is expanding higher, then that's the condition, it's expanding. After an expansion, there should be an obvious drawn liquidity, obvious imbalances in the run-up, and obviously short-term lows as well. But since this was just expanding and we're now moving counter to that direction, this is a retracement. How do you determine when the retracement is no longer a retracement and it's a reversal? Initially, you can never know that unless this traded into a liquidity pool of buy side up here, and then we broke market structure. If it's just pushing higher, you don't see a target and it starts pulling back, then it's retracing. You focus on the imbalances in the run-up, and those should be your target. Confluence is always good. So that's why this right here was highlighted for me, because there's an imbalance here. Old lows at the imbalance, perfect confluence for them to run into. And then we saw how they did that very aggressively. So without using another specific definition, that would be my answer. Anything else would be from, I guess, interacting daily with me or more often, and we could look at real live data and then share my interpretations of that. How price action in London kill zone different from New York? It's a very cryptic question. Many ways to answer this question. Generally, because London was seen as the start of the trading day, a lot of the initial liquidity that comes in London would usually be expected to continue in New York. So if London is bullish and we're breaking highs, we'd expect New York to retrace and continue. So in the beginning, that was the interpretation I had of London versus New York. Find London range, play the retracements, play the expansion in New York, and game over. But then as you got more knowledgeable, you realize that that's not always the case. And you can factor in different relationships between the range in London and New York, such as London is largely known for creating stops or running stops. What happens if there's a London session that's consolidating? What happens in New York? What happens if there's a larger range London session? What happens if there's a smaller range London session? You have to start looking at it from that perspective and then study it in hindsight. So yesterday there was a small range London, New York was what? And you write that down. And you keep writing it down, and eventually you should start seeing repeating patterns that help you to anticipate what should happen in New York. I watch your videos, time manipulation on Asian range, for the price action, and use the length time. Can you show me how you would do that for the S&P 500? I was trying to apply it myself. Okay, so I stopped the time manipulation series for a reason, and I don't think I'm going to continue it. But, well, I'm not going to continue in the direction I wanted to, but I have a couple time theories that I'm going to play around with eventually, and maybe put them on YouTube. So stick around, you'll see those, and I'll look at S&P in a bit. We can talk about that. How do you backtest? Could you please explain the steps you take to backtest effectively? Yeah, let's pick a pair that I actually trade. Like this guy here. And as an intraday trader, I primarily trade M5, M1, right? But if I'm going to be backtesting right now, this is going to be the order of my backtesting. Step one, I must clearly know what I am backtesting. I can't be just looking at old data, and then form fitting everything I see in the past to try to use it tomorrow. You must be clearly testing an idea. So whatever you're backtesting must be clear. So let's say you're backtesting timed delivery. I've mentioned many times that I don't trade before 8 o'clock, right? So let's say you're backtesting that, or let's say I was backtesting this. I would look at putting a line at 8 o'clock, looking at the delivery that happens after 8 o'clock here, and then making a connection to the price action that was before. What did this do after 8 o'clock? Where did it run to? And how could I have traded it or seen it before it forms? In the quick scalp video I did this morning, I was trying to do that. I wanted to highlight a liquidity run back inside this range here. I wanted to outline the difference between normal analysis and informed analysis for the guys in the group. So I'm pretty sure by now they haven't realized it. So I get to say it now on this call. Look at what I did in that scalping video. Look at where I highlighted for the range and all the good stuff. And then look at where I should highlight or where I didn't highlight. And that will show you why I wanted that run. So again, back to the backtesting question. What I'm looking for would be, how does the price action before 8 o'clock relate to the delivery that forms after. First thing would be this. Here's a range. Here's 50%. I can see that at 8 o'clock, we had price dropping into 50% of the range and then pushing higher. It didn't break outside of the range, so not sure what happened, but that's at least a start, something to note. We could look at one more day, and then I'll look at the next question. Previous day, 8 o'clock. Here. This was the previous data that we had. Again, same process. The range before. Here's 50%. We can see again, price drops into 50%. In this delivery, we actually take the low down here, and then we started moving higher. So either way, again, that's another day that I could have marked up as using the price action before 8 o'clock and looking for the delivery or a run after 8 o'clock. But yeah. So that's the what. And then once you find the what, just write down everything you see initially in the first run or the first go at doing this. Just write down everything you see. You don't have to know why. Just write it down, and then look for the patterns. What time did the next expansion start? Where did it run to? Is this a repeating phenomenon? And then backtest across pairs that you will never ever trade to see if the idea is mechanical. And that gives you that objectivity when you're trading, if this, then that. Why 8 o'clock? Lots of reasons. The first and most suitable reason is that I don't like the 7 a.m. Judah swing. Most days 7 a.m. creates a Judah swing, and I'm just not about that life. Very frustrated to trade. Unless you're going to be buying to sell or selling to buy, I just leave it alone. So that's the public reason. External range demarkers. What is it? External range demarkers. I don't think that was covered on YouTube, so I can't cover it either. But yeah, know what it is. Hi, Hassan. Can I ask you something? Yes, yes, you can. The rule of 8 hours is also available for Forex. The rule of 8 hour. No idea what that is. None, sorry. What would your steps or approach be to swing trading? Weekly chart, weekly change in the state of delivery. Weekly ranges and the range created on Monday and Tuesday. Nicholas, wink, wink. How do you use multi-time frame analysis? So I do use multi-time frame analysis, and I strongly believe that as a trader, you need at least 2 time frames, unless you're very, very proficient with one. You need 1 time frame to be very mechanical. That's your analysis time frame. Everything you do decision-wise should be based on that time frame. Then the other time frame is your execution time frame or your entry time frame. Once you're ready to enter, you drop to that time frame, and yeah. If this, then that. If there's no reason on my analysis time frame to look for an entry, don't go to your execution time frame and start, trust in the framework without a reason to. Ask mentorship related questions in mentorship group. Nice. I like that. Can you go over 90-minute cycles? Okay. Very, very interesting. So I'm not for or against 90-minute cycles, but I will maybe dedicate about 5 minutes to putting this idea to bed once and for all. So over the last couple months, we have all seen a whole lot of persons talk about authoring the idea of 90-minute cycles and labeling CLS as a strategy and all that madness, right? That's exactly what it is, madness. CLS is a liquidity clearinghouse, a settlement house. It helps large corporations just mitigate risk, essentially. That's all they do. They help to mitigate risk. So it's not a strategy, right? It's a liquidity clearinghouse. Naturally, if they're moving large transactions, in order to be effective, you need some amount of automation in that process. Ain't no way you can be up at every time of the day to factor in or help facilitate every single transactions across the world. So you need some amount of automation in that process. Allow persons to do this, you check it at this time, and then you do what you need to do. Full stop. The settlement cycle for CLS has been passed around as the holy grail of trading. And I have personally looked into it as well. I've tried to trade it. I have traded it both successfully and meh. And my conclusion was that it is meh, exactly. Because when it works, perfect, absolutely. When it doesn't work, there is no explanation why it doesn't work. There's always just it didn't work today. And while I'm fine with that, if the win rate is good, I'm fine. I'm trying to learn, right? I was trying to learn the thing. So if it's not clear cut for me to learn, or even have an assumption that I can use, then it's just not for me. And that's it. So none of the persons you heard of talking about, they authored it, they actually authored it. That's not how it works. The idea came about when ICT had a Telegram group, and he showed a UCAD trade, I believe. And he made a comment that he could do this every 90 minutes. And then everybody started dicing up charts into 90-minute cycles and then doing all that madness. That's where it started, and that's literally it. So that's it for 90-minute cycles. I don't think you need 90-minute cycles. I don't trade 90-minute cycles anymore. So my advice, not worth your time. Really not worth your time. Way too subjective. What confirmation do you consider before placing your trade? Do you suggest using limit orders when trading, order blocks to wait for confirmation? Order of delivery is I can't keep saying one thing is the most important thing, but order of delivery is very important. If you have a clear definition of what makes or what confirms a market structure shift for you, when back testing, look at all trades that form. Either they're for your model or against your models. Look at them and check if you saw the order block being formed first or the market structure being shifted first. Start there. Once you start there, you'll realize that if the order block is created before there's a confirmed market shift, probabilities will fall off. If the market structure shift happens first before the order block is created, then logically life is good. And that will go over a lot of heads because most persons view market structure shift as this low, this high, this is a breaking market structure here. Literally, that's what they say. It's a breaking market structure here and then long, perfect. Here, all this good stuff, this is a breaking market structure right here. It's way too subjective. And the reason subjective is because you don't have a set definition for what validates your market structure shift. It's still, if I see it, I trade it. Trade what I see type of vibes, which even that needs a definition. If you don't have a clear definition, it will hit and miss, hit and miss, hit and miss. I mean, I still hit and miss. Sometimes there are just some time frames that are not very friendly for me, or they're friendly enough. Yeah, that's it. Sometimes I'm trading M5, M15, and I can see the narrative, but I'm not factoring stuff that I normally would on an M1. And then that just makes you miss an entry or two or enter early. But that's it. Market structure shift is important. You need a clear definition for what defines your market structure shift. Start with there. Can you show us your secret, Matt Diana? Wow, I have no indicator. Yeah, price is the only indicator. Holy Grail is. I don't know. I really don't know if it was a rabbit hole or if it's one of those things that ICT can't teach, but it is what it is. Can you give a tip on order of delivery? Okay, I'm gonna give my opinions on a lot of things. ICT said context versus framework in quite a lot of his earlier videos, right? I interpreted context versus framework as why and then what. So think about that. Why and then what? If you know that the market is bullish, would it be easier to just find out where an entry should form? Rhetorical question. Obviously it would. If the market is bullish and I'm seeing down candles and impulses, I'll feel confident buying that down candle. If the market is bullish and I see an imbalance and we're trading lower into the imbalance, I'd feel comfortable buying that imbalance for a run higher. Why? If the market is bullish, I can always identify where a likely entry should form. Where the entry forms is the framework. The why is it's bullish. So the what is 50% should hold. 50% should push price higher. Sell side liquidity in discount should be run and then push higher if price is bullish. So that's in a very rudimentary sense, that's it. What and then why? Why and then what? If you go, this is a down candle and impulse, I'm gonna buy this because buy side liquidity is resting above here. Sometimes that will get you in line with what's happening. But then sometimes it will fail and you won't know why it fails. Simply because you didn't factor in why should that down candle hold. Market structure is bullish. Down candle should hold. And there you have it. Nice and easy. Right. Looks like the last of the question. All right. Awkward silence, no? No more questions. That's interesting. Let me give a little bit more breakdown on the trade I took. Oh, here we go. Coming. Salve money management. I didn't get the multi-time frame. Multi-time frame simplicity. Pick 2 time frames. One for analysis and one for entries, and don't do anything outside of that. Realizations and lessons from growing $100 account. Not a lot, and primarily because it's something I've done before. Maybe that's why I don't have a lot of learning points. But what I can say is when you're trading a small account and your intention is to flip the account as far as you can, you have to be more accepting of risk and be more accepting of losses, right? Kind of like us when we started trading, right? When we started trading, everybody wanted to learn. So you soaked up, any material you could get your hands on. And then you tried to put them all together to make that perfect system. RSI works over here. This works over here. I put them together. You have RSI and 5 other things on your chart. When it doesn't work out, because in hindsight, everything is already done. It's going to look perfect. But in live price action, when you're looking at it, it's going to be wild. I personally stopped using RSI when I think his name is VP, No Nonsense Forex. He was saying that it moves. So if the candle closes here and RSI is, I don't know, at a particular price, and then the next one closes down, the RSI will literally move from here and come down here. So once I saw that, I said, this is not showing me how to trade real time. It's showing me how I could have traded. So I started looking at it like any indicator or any system that can only show me the move after it happened won't help me to make money tomorrow. And then I use that to kind of weed out anybody I want to learn from as well. If you can't explain something to me that I can leave and then tomorrow I implement it, then no. If you're only going to show me what happened, and even if you're showing me what happened, showing me how I could have seen it so I can implement it tomorrow. But if you're only saying, this is a good buy, you would have gotten 100 pips here. Boom, next pair. Bro, I'm not learning anything from that. So yeah. Do you give private mentorship? I have a 1v1 group, right? Just sharing my model. That's it. And we talk and we chill. What do you consider in defining your market structure? Swing points or just naked logic? All right, let's play around with that. So it's a very tricky question, and I'll show you why I say it's a tricky question, right? So for the guys who know what I'm doing, they're going to understand, but then for everyone else, it might seem a little bit weird. So let's go to 8 o'clock. And let's go to 2 a.m., which is the start of London. Okay, let's take a look at that. Now, if I start trading here, and I'm going to factor in the range created before, well, then again, New York is 7. Let's say 7. At 7 a.m. right here, this is the range that we have. If I have this range available for me and I want to trade today, how would I use this information to frame my trade here? First thing that should pop up is the range we're trading in is here, which means liquidity is above and below the range. At 7 a.m., we had a spike, a nice little spike above previous range, and then price ran low. This run lower is taking out lots of lows inside here. So we could view this as a market structure shift, which means the last low before a run on buy side liquidity can be viewed as a market structure shift. And I think everybody already does that part, right? We have a low here, we have a run here, we view this as a market structure shift. Now, let's say we have a market structure shift right here, bam. You wouldn't have caught this. I'm being realistic. We wouldn't have seen that this was going to do all of this. But let's say it's done it. How do you factor this in your decision-making process? How do you say, I can go long here, or I can go short here, or I should probably not do anything and wait? That's what's important. So let's say you had a basic approach. You'd be looking at the lows right here. And then comes the part where everybody gets a little bit fuzzy on. When you put your fib on that range there, from that high, how do you determine which low you use? This low? Is it this low? If it's this low and this happens and then we break through, do you just adjust it? Oops. Do you just adjust it? Then once you adjust it, then do you say, this is where the market should trade above before going higher? So let's say it happened here. This high gets traded through. Then we pumped up into 50%. How confident are you to go short here? Would you be looking at just the fact that this is support broken? It should be resistance. Would you be looking at, I don't know, maybe this imbalance inside here? These are logical questions that you would probably have. If the goalpost keeps moving like this, your understanding will, it won't have a solid foundation. You keep looking at too many things. So when you're looking at a market structure shift logic, it should be clear. Why do I want the market structure shift to happen here? Why should it happen here? And what will it likely look like based on what's happening here? That's the approach that you should take, in my opinion. What was your biggest epiphany that allowed you to become consistently profitable? Fair valuation. Understanding fair value moved me dramatically above the break-even line. Simply because in the beginning, we all overtrade, and I was no exception. I overtraded a lot, but what killed me about over trading is not that I took a lot of trades, is that when you take a lot of trades, you win a lot, but then one loss, usually it's like one loss that just takes away half of your profit or maybe more, or a huge chunk. So while everyone will say overtrading is bad, is it really though? If I take 10 trades and I win all 10, is that really bad? If every single day I take 57 trades and I win 50 of those, is that bad? That's not bad. That cannot be bad. What's bad is when you take a lot of trades and you start accumulating losses, you don't manage those losses. There was a point in my career where I would take 10 trades, win all 10, take an 11th trade, lose all of what I made from all the 10 trades. Because you win 10 trades, so you're just so confident that you won't ever lose, that a trade is moving against you and you don't close. You're hopeful it's going to turn around. You're confident, and I've been buying for so long, this buy should work, and then it's dropping. So fair valuation. Once you understand fair valuation, it makes trading easier in the sense that I now understand why an entry should form here, even before it forms. I now understand that I can take this sell way before the entry forms. I understand that when price gets here, I don't need a second confirmation to go short. So this was the trade I took. I think it's in trade settings. I think there it is. Cool. So in the call today, I tried to explain that I was using, get that off, 8 o'clock. I was using this range to frame the trade. Since this is 50%, I raise at or below 50%, absolutely mechanical. There's no form fit in this logic. Here's the range. What is there? Don't just say it's 50% so it should work. There must be something there at 50%. This is there. FEG. Bullish expansion. We're tracing FEG. Okay. And I might, if I feel so inclined, introduce something else today here. But you take a look at that. Before 8 o'clock, if I'm bearish, there's only two things I want to see at 8 o'clock. I run on buy side liquidity so that we can get that market structure shift. Or I want to see liquidity already taken so I can trust my retracements in the premium and then go short. Simple. Here, when you look back, buy side run, buy side run, buy side run, buy side run, buy side run. I'm not expecting another one because we displaced away from all of that madness. So no, premium, then lower, right? So I was looking for that run into premium to go short, but I didn't want to trade today. So what did I do? Just paper traded it. It's Thanksgiving, paper trade, relax. So after this was formed, if you look at these highs inside here, I'm gonna take this off because it's taking up a whole lot of my chart. These short-term highs inside the discount end of this range makes this expected. So again, remember, we've already seen the buy side run, right? So we're thinking market structure shift, then lower, right? 8 o'clock, we have all these lower highs inside here, beautiful trendline stuff. That's liquidity. Whenever you have a range, and this is my interpretation. This is how I look at it. If I have a range and the market is likely to trade lower and highs are formed in the discount end of that range, they must take that. If they don't take that, I'm not interested. If I have a range and we're bullish and I have lows formed in the premium end of that range, they must take those lows for me to be interested. Because if I sell here and I put my stop here, then I become liquidity. If I don't know, sell anywhere else inside here, with my stop inside a liquidity pool, I become the liquidity. So that's why, you know where the liquidity is, or you become the liquidity. Since the liquidity is here and I want to go short, I don't want the market makers to have any reason to trade against me once I get in. So wait for them to take liquidity, then go low. So watching this live, put liquidity here, then displacement lower. This can possibly be viewed as ICT's 2022 logic. Liquidity displacement, FEG, bam. Nice scalp. On an M1 chart, same logic. This is now your dealing range. All of these highs are in discount, below 50% here. So the need for them to run that just makes sense. There. So wait for them to run it. No run, no run. Then that run right here. Once that's done, then you can start expecting secondary entries. So the market structure changes its state of delivery once we run on these. All right. So after this takes buy side here, state of delivery is on sell side. Where's the sell side liquidity? These lows. And this is that old FEG. So we have liquidity inside fair value, which makes this cheap. Write that down. Liquidity inside fair value makes it cheap. So we have that initial run here. All that liquidity is now very, very cheap. When this retraces without taking this low, I short. And I did this without looking at the M1. It was purely M5. Short this, there, and I wanted to record all of this. I don't know, I just wanted to, but then it didn't. It didn't. The take profit was hit really quickly, so I kind of ended the video early. But that was that. Very, very nice. Anyway, somebody asked about 90-minute cycles earlier, right? If you put 90-minute cycles to bed and you look at 3-hour cycles, right? So somebody's probably saying this is another rabbit hole. And you look at 3-hour cycles, you will find everything you need and you will never look at 90-minute cycles again. All you have to determine is where to start your time from, and that's game over. When do you know if liquidity is really taken, or are there still liquidity left? That's an interesting question. Very, very interesting. I think somebody asked me a question like that recently. When you know the drawn liquidity, it keeps all of that logic at bay. So let's play devil's advocate here. Let's say this was, forget that it's a 1-minute chart, right? This was another time frame. And when price sold off right here, you expect, let me clear this up. You expect the drawn liquidity to be at this low. That's what you expect. This low, or at the very minimum, opening price of that candle. Right there. Market trades down, hits it right here, and it pulls back. Would you be confident enough to sell this again? Answer is probably going to be no. I'm going to explain why I thought this was a high probability short. Follow along with this drawing. If this is a range of price, and then inside that range we have bam, bam, bam. Let's say bam here, and a retrace, right? If you go short here, where would you expect the liquidity to be? I don't think you'd be looking at anything on this leg, and I don't think you'd be looking at, well, probably you'd be looking at something right here. So let's take this leg and then highlight it somewhere over here and say that's the leg, and you went short here, and this is the low of the range. Unless you're looking at lows formed inside this run up, the logical place to expect price to be drawn to is here, which is here. So when a dealing range is formed and we retrace inside the range, it is very logical to expect price to break outside of that range. Whether it breaks out or not is irrelevant. What's important is it is likely to trade lower, which means between my entry and my exit, if I can find any logical area to exit with a decent profit, I'm fine. If it goes lower, okay, cool. If it stops right there and then pulls back, okay, cool. It doesn't matter. What's important is identifying the next logical direction for it to expand. Dealing ranges, when they take buy side and sell side and retrace, they generally expand outside of the range. So pushing that idea a little further right here. Buy side, sell side. Here's my dealing range. Here's my retracement. So you can always put that 50% line on. When price retraces inside a dealing range, the next logical direction for it to expand after the retracement is lower. It doesn't have to get down here. It really doesn't. But let's say it does. Let's frame this idea for a second, just for a second. Let's say you went short there and your stop is there. Put that right there. I don't know. And then there's your objective is for it to expand to the range low, which is going to be this. By itself, this is a 4-hour trade. So if you trade RR, this is not a 4-hour trade. You need to know, or you should, in my opinion, know where 50% of this move is, right? From that candle to that point, 50%. Take the actual thingy off. So this to here is now your trade framework. You can manage around this in many ways. One thing you can do is have a mechanical approach that says, once we trade below 50%, I'm at break even. Once you're below 50%, I take half off and let the rest run. Once I'm below 50%, I take 75% off. I don't care. You decide. These should be logical areas that you pay attention to as the market is trading in your favor, particularly because I was taught to exit and enter in opposing delivery. If I want to buy here, I want the candle to be going down, and I buy it, and I want it to snap back and then go higher. If I'm going short, I want this to be trading up into the level, short, then it snap back, and then you have a really nice wick entry, right? That's what I like. Now, when you're exiting positions, right? In the beginning, I would watch this level. Let's say that was my take profit level. I'd watch when price is going through, and I'd just be hoping it keeps pushing forever so I can get that 100R that I used to see on Telegram, on Instagram. Even if I got 100 pips right here, I wouldn't be satisfied. I'd be waiting for it to retrace. Then I got scared and I'd start closing when it's retracing. So sometimes, you try to close here and the market does this and you get this instead. Boo-hoo, your fault. So once that happens to you enough times, you start realizing I need to change something, and you start exiting when price is moving for you. So you're short. This is the level you're watching. As we're trading through, take partials mechanically. It snaps back after, I don't care. It keeps pushing, I'm break even, and I'm enjoying the risk-free profits. So dealing range, back inside the dealing range, high probability expansion is to leave the dealing range. It could be a sweep on the lows and then fly. It could be sweep to the low and then console. It could be whatever. But the idea is trading lower is high probability. That's all you have to focus on. The direction. That's how you determine the direction. You take this to a higher time frame, you're able to frame a higher time frame price swing. Then all you have to do is go in the market each day with the logic that it should be trading toward that higher time frame target. And you just milk it along the way. Where do you have to start our 3-hour cycles? Good one. Why does sometimes price fill the whole FVG, but while it sometimes it does not? It's based on how we trade through the low and where the FVG is formed, in my opinion. But then that needs a little bit more clarity, I know. Please expand on what you meant when you said liquidity inside the FVG is cheap. Does it mean probability of it being run? Yes. Yes, that's exactly what it means. I'll show you a drawing in a second, or maybe a live example. If given a chart, doesn't matter the time frame, where do you begin? What time is it? What time is it? That's it. That's where trading starts for me. What time is it? Because I believe that delivery ends and begins with time. So if a liquidity pool is going to be created at the end of the time which it should be created, then yeah, you don't want to. So what if somebody said to you, hey, the market is going to run on sell side between whatever time this is, 9 o'clock and 9:16. Let's say somebody told you that the market is going to run on sell side liquidity within that time. You know that for a fact. Okay. Which of these scenarios would make you more money? One, going into the market, it's 8:51. I'm just going to sell this now and then wait for it to run below these lows. Market's trading higher, you get stopped out, blow your account, market crashes. Here, sell at 8:54, market puts in a little bit of drawdown, one big candle against you, you probably get scared, close, and the market crash. Or, since you know from, let's say, a reliable source, it's going to start at 9 o'clock, then at 9 o'clock, you start looking for a reason to go in the market. The reasons are easy. Either want to wait for a sell side liquidity run or a premium array. If it should start at 9 o'clock and run on sell side, and I require my short entries to give me a buy side run before I enter, when this happens, I'm like, yes. So once I enter, there's no reason to go against me. Now, what do I want to enter? You already know I'm looking at this candle's opening price. Once we trade below here, short. Logical stop, couple pips above that. Then you look for the sell side liquidity. This is the first one right here. So that's my first target. If I can only trade 1%, I have a choice. If there are multiple targets, do I use multiple positions? So instead of one lot, I use 0.3 or two 0.5s. Set TP, let them run, manage them if I get the chance. Or do I just put it all on one position, partials here, let the rest run? Logical entry point here, logical, whatever. So even though this looks like a great market structure, market maker model, whatever, I don't know, yeah, market maker model. If you only focus on, okay, here is an entry here, and just think about that. Hey, this is an order block, so I just use it. You will win and then you will not win sometimes. So you want to be mechanical. What time did this run start? All that good stuff, and then life is good. I don't have to check what time this is anymore. Usually something magical happens around here, but it's just how you look at it. So if I, without saying that, if I asked you guys, where was the best entry right here before any of this conversation, most persons probably just point to this for no apparent reason. Just point to that and say that's a good trade. Or point to this and say that's a good trade with no reason or why. Or you would look at the trade and then validate the trade based on the market structure. I personally don't think that that's the way to go. I think looking at time first, what should happen at this time, what's likely to happen at this time, and then taking the trade gives you a way better probability. But yeah. Could you give more depths on DOL? As is it just highs and lows? It's old highs and old lows, yes, but there are other kinds of liquidity. But let's just focus on old highs and old lows. It's old highs and old lows formed within a time period. That's what it is. It's not just a high or a low. So let's say that this is the liquidity in the market at this low. Okay. And we know that what time is this? 9:30. At 9:30, the market should run for this liquidity pool. Let's say we know that for a fact, right? Just creating a scenario here, right? Don't quote me. We know that at 9:30, the market is likely to run for a liquidity pool. What that means is if we have a run on this liquidity or this low prior to 9:30, I'm going to discredit all of that run like it never existed. Hear that? I'm going to discount all of that run like it never existed. So let's play. Let us play. I'm going to delete all the drawings and let's play. This is not financial advice. This is not drawn to scale. It is simply for entertainment. So let's say that we have all the highs inside here being taken by that candle, right? Let's use the example that we know that at 9 o'clock, 9:30, price should run lower to this level, and it should start at this time. What that means is if price runs lower inside here, you can do this. This is the only time I'll do this. You can discredit all of that run. And then you go back to your order block. Time meets price. Let the church say amen. It's my video you had used 7 a.m. and the rest 8 a.m. Yeah. I've always been hinting at stuff that I'm doing and then not showing everything. But I think this call is getting pretty long now. Not trying to do another 2-hour call. Hopefully this was entertaining, to say the very least. And thank you guys for coming out. Leave you with a little bit of thought-provoking stuff. Enjoy the rest of your day. Happy Thanksgiving.